We're going to calculate the stock price for Zynga. So the first thing we need is the market cap, which is 8.75 billion. We'll put that into the model. And the stock price of 9.15. Now, if you take the market cap divided by the stock price, you get 956 million. That's the number of shares outstanding. Next, we need the free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount that number back to today's value. And that's what we're doing in this video. Next, we need net income, and that's on the income statement. I'm sure a lot of people here play Zynga on their iPhone. I know I do. Revenue. And as you're pulling in these numbers, you always take a look. You know, really nice increase in revenue, almost doubled from 2016 to 2019. And they lost money in 2016, but they managed to make a profit the next 3 years. And free cash flow has been improving as well. So all good signs. Now we need a capital structure of the company to figure out what discount rate to apply to the future cash flows. So 17 million of interest expense. Let's see how much debt they have. We'll go to the liabilities section of the balance sheet. No current debt. So 570 million of long-term debt. So they pay 3% interest on the debt, which is a good rate. Interest payments are tax deductible, so let's get the effective tax rate. Income before tax, 47 million. Income tax is 5.4 million. So the effective tax rate is a really low rate. That looks too low. That's why it's hard to look at the income statement, because they use accrual accounting. So a lot of the stuff on here didn't actually happen in 2019. It happened like 2018, 17, 16, and they're accounting for it now. So you have to look at like many years to understand the income statement. So let's look at 2018. That looks more reasonable. Or even 2017. That looks more reasonable, the tax rate. You could always look in a 10K to find the effective tax rate, but it's a lot easier here. 29%, looks right. So the cost of debt is only 2.1%, and the weight of debt in that capital structure is only 6%, which is really good. Now let's find the cost of equity. And wow, that's a great beta. 0.28. That's volatility, so it's not volatile at all. So the cost of equity is 4.5 and cost of debt is 2.1. Now equity is more expensive than debt because equity sits lower in the capital structure of a company. In the event of a default, debt holders are paid before equity holders. So equity holders require a higher return for that greater risk they're taking. So the WACC is pretty low, 4.33%. This is one of the lowest WACCs I've seen. So they don't need much of a return in order to be profitable, only 4%. So let's go discount the cash flows by that 4%. And we estimate future free cash flows in 4 years. Then we do terminal value, which is all the years beyond year 4. We discount that back to today's dollars. And the value of the company is $11 billion. When you divide that by 950 million shares, you get a stock price of $11.77. And it's trading at 9.15, so we consider this a buy. It's trading at a 22% discount. And that just shows you what having a lower WACC can do for you. Because look at the stock price, $11.77. What if they were more risky of a company, like they had a lot of debt, the stock was volatile, and say it was 15%, like a lot of companies. Look how low the stock price is, $1.67. I mean, what a big difference. And to try to help you think of it, the reason WACC affects things so much is because think of like if you had a mortgage at 3% interest rate, okay? So you had a $100,000 home at 3%. That's $3,000 a year in interest divided by 12. So $250 a month. So if you have a $100,000 mortgage, 100K. I'm a math teacher, by the way. At 3%, you pay $250 a month. Okay. Now let's just pretend you had a $300,000 mortgage, just to make it normal, because I think that's probably average. $300,000 mortgage. That's triple. So $750 a month. If you had a $300,000 mortgage, $750 a month is how much interest you're paying on a mortgage. And that's if you're a good borrower. 3% means you have a good credit. Okay? Let's just say your friend never pays his bills on time, has gone into bankruptcy, and has terrible credit, and his rate is 6%. So he pays $1,500 a month. That's a big difference, right? You pay $750 a month for your $300,000 home. He pays $1,500 a month for his $300,000 home. He is paying a lot more, and therefore the value of his assets go down dramatically because he has to pour that much more money out the door every month just in interest payments, just to maintain his house. So the higher risk you are, the much worse your company is going to be. Same thing with a corporation or an individual. And it makes a big difference when valuing a company. That doesn't mean they're going to stay this way forever. But right now, this is what it indicates, which is a great sign because they have low debt. So let's look at the historical stock price. It's been pretty low, around 5, 4, and it's come up. It's interesting to look at this because if you look at, I've looked at over 100 charts the past 2 weeks because I've been doing so many videos, but every stock has looked like this, like fell off a cliff. It's been high, 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 big drop. Then it comes up a little bit. This is opposite kind of. It's low, 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 and it keeps going up. So this indicates a good sign for a company that they're increasing during this time and not decreasing. So it's a good sign, but who knows what the future will hold. Everybody has their own opinion on stocks and on companies. This is just my opinion. It's my model. So thanks for watching.